Welcome, everyone. We're going to give everyone a minute to load into the webinar. And welcome to the quarterly economic and market update webinar. So welcome, everyone. I'm Chris Boyd, and with me today is Brian Regan, our firm's Chief Investment Officer. In our webinar today, we'll be reviewing the portfolio results and strategies for the upcoming quarter. We will be recording today's webinar on today, July 19th, 2022, and your participation implies consent because we are recording it. Compliance information will be held at the back of the recording, so at the back of the slides, so please do take a moment to review that. Remember that opinions are subject to change, but information has been derived from sources thought to be reliable. This webinar will be posted on our website and our YouTube channel later today. So if you need to go back, don't hesitate to review any of it or share it with anyone you'd like to. Because things are continuously changing, we encourage you to listen to our radio and podcast program for our most current thinking from week to week. Of course, you're welcome to plan a call or to arrange a meeting, particularly if you think your circumstances or needs have changed, or if you'd like to have a one-on-one conversation about your portfolio or your plans. Today's agenda is listed on the screen. We're going to discuss one of the issues that's on everyone's mind, inflation. We will discuss the causes and policy responses, including monetary policy, fiscal policy, the war in Ukraine, and much more. We'll share with you what AMR has been doing to prepare for these market conditions over several quarters, and how we are preparing for what is yet to come. There will be opportunities for questions if you'd like to ask questions. We're planning to save that primarily for the end. If you have something that's particular to a slide, you don't feel that you have to wait to the end, but we do have a Q&A button at the bottom. There's also a chat area. You could use either one of those to share a question. Participants should expect the program today to run at least an hour, but probably a little bit longer. To get things started, let's review what's been happening in the markets and our investment strategies. You know, not a big surprise. Markets have been down in quite a big way over the quarter. You can see a range of different equities and other asset classes being identified here with a range of risks. Good to know that our most aggressive strategy in our active allocation ETF mutual fund discretionary strategies is holding up quite well in comparison to these strategies, these indexes. Unfortunately, it is a situation where markets have been in decline across the board. That doesn't exclude fixed income as well. Brian, anything you want to add on this?
No, I think that's the message.
Yeah, when it comes to the bond area, you know, the aggregate bond index, even, you know, where we normally look for buoyancy, has also had some declines. And high yield bonds also. Our 30-70 strategy, the preservation, we refer to it as a preservation strategy, which has about 30% in stock generally, has held up quite well compared to even all bond strategies. So challenging times for everyone on all ranges of the risk spectrum, but even so, you know, in relative terms, we feel as though our strategies have held up. It's just not easy when you see things going down. I think it's important for investors to keep a longer term perspective. You know, we're showing you year-to-date information here, but if you're looking at your accounts over a 3 or 5 year period, results are significantly better and it's a very different story. And I think as we look 3 years out as well, we can expect something different as well. So let me turn things over to Brian to talk about some of the causes of what's creating this disruption. And one of those big causes is inflation.
Yeah, so when I go through this, I want to be clear that this is not meant to be political at all. We're not coming from this from a red team or blue team point of view. I'm just trying to give some data and some perspective through various charts. So, I hope we can keep down that impulse, the political impulse that we might have when we talk about inflation. So inflation's undoubtedly high. This is PCE, which is the preferred measure of the Fed, personal consumption expenditures. This is typically lower than CPI, which is often reported in the news, which could be a little bit insatiable to take in when you're seeing numbers higher than 9%. PCE, one of the big changes is it surveys different types of different businesses rather than individuals. It takes into account substitutes, so typically it's lower versus CPI. So we can see that it's still high though, 4.69% on the core. The Fed wants to get down to 2%. There's a lot of work to be done there. It's far above the target. So how did we get there? First, I'm going to talk about the surge in fiscal spending. Then I'm going to talk about monetary policy. Then we're going to talk about the change between services and goods during the pandemic. And then finally, we're going to talk about the war in Ukraine and how all that built up over time. So you can see this is a 3-year chart. And the first thing I want to talk about is the CARES Act. That was the first very significant bill to come out of Congress during the pandemic. You can see that we were in a bit of a deflationary spiral, dramatically moving down quickly from the 2% target where the Fed was actually achieved prior to the pandemic. And it was falling rapidly before we got that fiscal response. And that was clearly the right thing to do since we want to be around that 2% mark and not below it. Being below it can be very dangerous. And then towards the end of 2020, during the end of the Trump administration, there was a big omnibus budget bill signed. There was very, very significant COVID spending at the time, including increased unemployment and checks out to individuals. I believe it was December of 2020. And then you can see that there's a clear bump in the inflation numbers just a few months after that, as all that spending and new money fed into the economy. And then finally, we had Joe Biden became president, and in January, they pushed through a bill, the American Rescue Act. I believe it was signed in March of 2021, and that gave us another level of inflation. Now, the fiscal spending wasn't alone. The Federal Reserve kept interest rates very low, probably for too long. In hindsight, probably for too long. So we could see that the 5-year was around 1%, and now it's around 3%. That's a 2% jump in a little over a year. So they are aggressively tightening. But a year ago, they were significantly lower than they are today. And we know that we have high inflation as of right now. So it was likely too low a year ago. You can see that the increase in monetary policy has increased mortgage rates rather significantly. The gray bar there is 2020, the blue bar is 2021, and the red bar is 2022. And you can see that there was some tightening between 2020 and 2021, but it's become very, very significant in 2022. So they were behind the curve in 2021 and making up for the fact here in 2022. Now, there's another thing that I have to admit caught me as well. I'm calling it the transitory head fake. Between the effects of the Trump bill and the Biden bill, we had a kind of a lull. It's called a 3-4 months lull in summer of 2021, where it looked like core inflation was plateauing. So there was reason to believe that that inflation wasn't going to continue to be as persistent as it has been. And at the same time, the labor market, which the Fed had told us they were going to prioritize in Jackson Hole in 2019, still had some room to run. And we saw that as labor started coming back on the supply during that same lull. This was an additional reason to believe that the inflation was going to be capped as more people came into the labor force. Generally speaking, that normally means that wages will have a cap on them and you won't have an inflationary spiral. As we can see, that was not the case. This excess spending, unemployment insurance, excessive amounts of demand, and the fact that people couldn't come back into the labor force for one reason or another. Personally, my personal anecdote on this issue is daycare. My child had to be home unexpectedly for weeks at a time in some stretches, just because she couldn't go to daycare because of COVID. This means that people couldn't go back into the workforce, and that put some pressure on wages. And even more recently here in 2021, with the excessive fiscal spending in 2021, we've really seen that the surge in wage growth as of late. So this is one of the reasons that we've seen things like rent be persistently high. People can afford more rent, spending more on rent, and pricing out people that otherwise would have made 6% less a year ago. Now, we also did have a supply shortage. So this chart shows on the left-hand side, it says that the goods percentage of the economy, and the right-hand side shows the service percentages of the economy. And you can see that there's a dramatic change when the pandemic starts. So we needed to produce more things in order to satisfy the excess demand that was happening from people being locked down and people having excess money in their pockets. Now, one of the big problems was China was not getting back to their industrial capacity. If you're over 50 here, it generally means that your industrial production or manufacturing production is increasing. If you're below 50, it means that you're contracting. So you can see that the United States, both services and manufacturing PMI, were well over 50 and have been since summer of 2020, since we really, right after the pandemic meltdown, right after in the summer of 2020, the United States popped back, where China, especially with their no COVID policy, has struggled to grow their manufacturing capacity to meet this excess demand, which has caused problems in addition to the well-documented supply chain issues that existed with all the ships backed up at Long Beach, for example, which is less of a problem today, but definitely notable in the past. Now, there's been a lot of rhetoric and conversations that I've had with clients about there not being enough supply of energy. And I'm moving on to headline inflation here. Everything I talked about before was really the effects of core inflation. And what we're going to see is there's a big gap between headline and core inflation, and that gap is growing. And one of the reasons is energy supply, food supply, and the things that are influencing them. So the purple chart here is crude production. Now, and the gold line is WTI price. Now you can see during the pandemic, the price fell off a cliff as people locked down. And production also fell off a cliff from about 400 million barrels per month in the United States to about 260 at the low, around 280, around between 260 and 280 for the time being there. And now we're back up closer to 380 million barrels per month, almost back to pre-pandemic levels. So the spigot has been turned back on, but the lack of inventory hasn't been caught up with yet. And more importantly, you'll see here that we can't refine the oil fast enough. So unfortunately, you don't put oil in your car, you put gasoline in your car, and oil needs to be refined to be turned into gasoline. So we're doing it as the refiners are at capacity, pushing out as fast as they can. But what we'll see here is that they haven't been able to keep up with demand because the demand hasn't fallen. So we had that supply shock, but we didn't produce any oil. Refineries were operating at low capacity to no capacity. And then, no inventory was built. Then we spent down all that inventory, and now they're trying to play catch up. And it's hard to play catch up when demand doesn't go down. So what we'll see here is that, it's not just the price of a barrel of crude that goes into your gas tank, but it's also refining, distribution, and marketing, and taxes. And right now, refining is what I would call the bottleneck. So we've seen a kind of a rapid change recently in gas prices as the refiners start to catch up. But, I think you're really going to have to see a fall in the demand side for gasoline before you see that real drop that we all want to have. Chris, I'm going to pass it on over to you so we can talk about Ukraine and that effect that it's had on headline inflation.
Well, I think it's, Brian's done a great job explaining, this distinction between core inflation, which is really what the policymakers are paying attention to, and the headline inflation, which includes food and energy, but where we all feel a lot of inflation lately, the effects of this inflation. Now, as much as, there have been other causes contributing to these issues before, the Russia invasion of Ukraine simply exacerbated these concerns. And you can see on these graphics that the war increased food prices from an already high level as fertilizer and corn and wheat, sunflower oil prices have erupted, and it's just created more strain when it comes to the prices of these kinds of issues that already existed, perhaps. When it comes to this slide, you can see that Russia provides hundreds of billions worth of energy product, primarily to the European Union. And sanctions created a disconnect in the supply and demand of available products. So it's worsened the challenges we face. Brian showed this slide earlier, and I think what I find interesting about it is you can really see sort of a disconnect sometime this year when, the yellow line, which reflects the headline inflation, and the line below it, which is the core inflation, you can see this growing disparity between them, that we start to see the core inflation start to taper, where we're really not seeing that yet with headline inflation. And that is at least in part brought on by some of the pressures from the Ukraine war. Anything you want to add to that, Brian?
No, I think this is a really important chart. And one of the things that I want to concentrate on, we understand that inflation's high, but we also understand that the policymakers are more concentrated on the core. And I think that's really important when you're thinking about asset allocation going forward, that we want to concentrate on the headline inflation, or do we want to concentrate on the core inflation? And I think we want to have a bias towards the core inflation. So to that point, let's talk about inflation going forward. That's what caused it to go up in the past, a variety of reasons. And now we're going to see those same things, fiscal, monetary, and goods versus services, and the war. How is that playing out going forward? Well, federal government spending is down dramatically. Least deficit spending is down dramatically from 12.4%, and this chart says 4.2%, but the most recent numbers is going to be 3.3% for 2021. And this has some dramatic effects. Deficit spending is both stimulative and inflationary, which we've said over and over again. So we're going to see in further slides that this lack of government spending is slowing down the economy fairly dramatically. But it should also mean that we're not going to have as inflationary environment as we did in 2020 and 2021, where you can see in 2020 it was 15%, and 2021 12.4% was the budget deficit as a percentage of GDP. So we're not spending like we were. Let's talk about core. Used car prices and new car prices, they're a pretty significant part of core inflation. And I think it's gotten a lot of headlines. So you can see in January of 2022, used car prices had a 45% change. That's a pretty dramatic inflation number in one period. But the good news is that in June, it's down to 11%. So that's a trend that's our friend when it comes to core inflation. Now, we're also seeing some commodities, notably here, the copper, cotton, and aluminum, in very, very significant bear markets, and it happened very, very quickly. I think these commodities topped out in June 8th, and over the last 40 days, 45 days or so, just seen really, really dramatic declines. So this is good for inflation, but it's also indicative of the fact that we have a slowing economy. Now, finally, I don't want to spend too much time thinking about that blue line. That is the consensus estimates on Wall Street on where Q2 GDP is going to be, which is around 3%. But it's in a lag. It's typically overly optimistic. But the Atlanta Federal Reserve has a what they call GDP Now, which is supposed to be a real-time update of the data that are the inputs into GDP. And you can see that they're expecting another negative quarter. So this would be a back of the envelope recession. I call it back of the envelope because the Bureau of Labor Statistics, I believe, is the agency that calls recessions. And there's a variety of factors, but generally speaking, I think the most people understand a recession as 2 consecutive negative quarters. And it looks like it's probably going to happen, the second quarter of negative growth. Now, there's a few things that are playing into that. One is the lack of government spending. 2 is a lack of inventories being built. There's excessive inventory. And we know this from listening to Target calls, Walmart calls, Amazon calls. They all say telling the same story. They overbought. And now there's going to be some significant discounting. And I can tell you from personal experience that there is some very, very significant discounting, particularly at Amazon and Target, where I have done some channel checks. So that's good for inflation, not necessarily good for corporate profits. And finally, that the strong dollar is hurting exports, and it's increasing imports, which is also negative to the economy.
Before you move on, though, you had indicated that despite that appearance of 2 negative quarters of GDP, you don't think it's likely that the powers that be will actually consider us in a recession. Just elaborate a little further.
Yeah, so my general understanding is it's largely a judgment call. And I think that the labor market is a big input into that judgment. And right now, the labor market's still very strong, despite these 2 consecutive negative GDP prints. There's still 2 open jobs for every person looking. The labor force still has some room to grow. Wages are high. We're not seeing layoffs. You're going to see, I believe it's on the next slide, that unemployment claims have started to tick up, but they're still at healthy levels. We would probably consider it to be closer to unhealthy if it gets to that 320,000 a week, which is trending up to. So this is just showing that the Federal Reserve is trying to slow down the economy. They're being successful, as we're seeing in the GDP Now estimate, but they haven't been completely successful at dulling down the employment picture, which I think they'll need to do if you want to see things like gas prices come down. If 2% of people stop driving to work every day, that demand picture will change dramatically. And I think ultimately that's what the Federal Reserve is trying to do. Now, whether or not that puts us in a deeper recession is debatable. I think this is one of the reasons why earnings expectations haven't come down pretty dramatically. The people will spend money if they have a job. And right now, their personal balance sheets, although getting worse, are still very healthy. So, this all shows into a kind of a strange situation where we have great employment data, an obviously declining economy. We have high inflation, but obviously, some anchors holding down inflation going forward. We have high headline inflation that seems to be getting, not much better quicker. Well, we have obviously declining core inflation. So it's an interesting dynamic, and we'll talk about how, in a few slides from now, how we're planning on addressing that going forward. And the short answer is we're going to be very, very, very diversified. So a lot of people, Chris, that a lot of people have asked us, what have we been doing in the face of this inflationary environment? And that's what the next few slides are about. It might not be completely obvious that we're making some fairly significant changes, but we have been making some fairly significant changes. And it's about positioning on the yield curve, positioning for certain risk assets, and maintaining diversification. So first, let's talk about duration. Duration is a measure of interest rate risk. If interest rates go up and you have a lot of duration, your bonds will do worse. If interest rates go down and you have a lot of duration, you will do better. And we acknowledged back in last summer, when we were having that transitory head fake, as I called it before, we were taking some fairly significant duration. And the reason for that is because you typically get paid more. And if inflation is going to go down, you usually want to take advantage of that positioning in the yield curve. Now, we were still, the aggregate is around 7, we were around 4. So we were still taking, significantly less than the index when it comes to interest rate risk. But over time, most dramatically in October, we dramatically lowered our interest rate risk, where this quarter we're going to be looking at around 2.5 years in duration. And that means that we're going to be participating in the higher rates quicker, but we're not going to be hurt as hard as the typical investor if interest rates continue to climb rapidly. So beta is a measure of volatility risk in the stock market. You can see 2021 was a fantastic year in the stock market. It might be hard to remember that by now, but it was a fantastic year. And that was an example where, we were overweight beta. So we were taking more risk than the stock market by about 4%. So, 1.04%. And then at the beginning of this year, we recognized that the headwinds ahead of us, and we dropped that 4% overweight to about a 1% underweight. And today we're at a 2% underweight. So we're taking less risk in the overall market. Now, this is a risk asset index, and I kind of created this myself. And what I mean by a risk asset index is in July of 2021, that was when we were taking the most risk in the last year. And you can, whether risk is defined by stocks or high yield bonds. And you can see that through April, we dropped that by 12%. So pretty dramatic change. And the most dramatic change came at the beginning of the year as we were playing a little bit of defense on the portfolios. You can see that between April, the second quarter, and what we're going to start doing when we do our trading after we wrap up this webinar is that we're going to start to take a little bit more on the risk asset index. Still very much underweight from that 100% mark that we were in July. But we think there's a lot of opportunity in high yield, which we'll talk about in future slides here. So the Q3 major portfolio changes, here we go. This is a high yield story. So that when the purple line gets higher, that just means that the price on high yield bonds are going down. And we have been underweight in high yield bonds for quite a while now. We actually haven't had any unsecured high yield bonds. We've had senior bonds. So the price has gotten significantly cheaper. Now this 6.52, you got to add 3+% on top of that, because this is what's called the spread over treasuries. So we're getting paid close to 10% on high yield bonds. Now, for us to lose money on this position, you would have to have somewhere the defaults, nearing 10%. Most high yield asset managers expect defaults to be below 1%. And the reason for that is because during the low interest rate period during COVID, they were able to term out their risk. And they don't really have any significant maturities that they need to worry about for a few years here. So I consider this one of these opportunities that a poor liquidity market can hand you sometimes. The last time that we got significantly into this was during the pandemic, and it worked out very, very well for us. And now we're being gifted another opportunity here. Now, spreads could continue to go higher, and that will show an unrealized loss. But I believe that will be temporary as the interest rates start to pour in over time. And if we get any good news on the economy, which will happen eventually, you could see a dramatic decline in that spread, which would be great for the prices of the bonds that we're buying. So this quarter, I wanted to make an active effort to address common questions that we're getting. And hopefully, your question is going to get answered in some of these common questions. So why not energy? I think there's been a knee-jerk reaction. We're seeing that the prices at the pump go up. We're seeing energy stocks did really, really well for a time being. One of the only positive sectors for the year. And my answer is that we own a responsible amount. We own alternative commodities, whether it be oil and gas, but also like copper and wheat, where we're well diversified through a commodity space. And then in addition to that, you own something called carbon credit futures, which is basically going to do really well if we burn more carbon. And if you believe that we're going to use more and more energy of differing kinds, you should expect that to do well over time. And as we see here in this chart, that carbon futures is down less than some of these other things that we've had over time. Down 2.75% over the last quarter. Isn't too bad. I mean, it's still negative, but not great. The commodity index, has been very, very volatile, but not nearly as volatile finally as the energy index, which we see has cratered along with some of those other commodities that I showed prior. So you just want to be careful how much you own of these things. And, we are overweight commodities, but we want to make sure that we have a responsible amount because we know that there's no secular growth here and it's very, very cyclical. Okay, why not healthcare? Well, generally speaking, 12% of your portfolio is in healthcare because of the various ETFs and mutual funds we hold in the portfolio.
12% of the equity weight.
Right. So we don't have an ETF in there that specifically says healthcare, but a significant amount of your portfolio, rest assured, is going to be in healthcare. And I just pulled here some of the more significant healthcare stocks: Johnson & Johnson, United Health, Pfizer, and AbbVie. And what I really want to get across here is, they're pretty expensive. We talked about how we're getting 10% from high yield bonds, which are, objectively safer. It's a contractual obligation to collect cash flows, debt cash flows. Where healthcare here, this is the earnings yield. So it's essentially the proportion of earnings that you should receive over the trailing 12 months. And you can see that you're getting between 3 and 5% on those stocks in the bottom. And we all know that Pfizer came out with the vaccine and it's doing very, very well because of it. But you're still only getting 8.5% there. So these numbers assume no growth, sure, but this is a low growth industry typically, especially for some of these larger stocks. So on a relative basis, I'd rather be there's more opportunity and less risk in the high yield market. Why not utilities? The answer is I'm not against it, but our beta is already low. It's already below 1. So if utilities have a beta of about 0.5, if I added a significant utilities position, my beta would be dragged down fairly significantly, and I won't be able to participate in a rebound nearly as well. So I understand that I want to play defense, but over the longer term, I don't want to be short-sighted here. Over the longer term, I'm going to need some exposure to the market if we're going to make some money. Why not concentrate on dividends? Well, first of all, if you really are interested in dividends, we do have a dividend-oriented strategy. It typically underperforms our non-dividend oriented strategies. And the reason for that is, lately it's been doing relatively better. So it is objectively, seemingly less risky in this type of environment. This type of environment will likely not last forever though. And it typically does not do as well over the longer term. And again, I don't want to be short-sighted. So, we have seen our dividend yield go up as prices have fallen. So we are going to get that benefit. I believe the average strategy has about 2.3% dividend yield right now. That's much higher from where it was a year ago. But it's not something we're concentrating on. Oftentimes it's better for companies to reinvest their cash into significantly good projects rather than pay it out to shareholders.
I would just argue for a moment. We find that when we use that strategy, it is best used as a complement for people who have either a preservation mindset or a conservative mindset, and they want something to complement what they're doing that is maybe not as much risk as our full-on active allocation strategies, or can be an alternative to something we're doing in one of those other strategies. So I didn't want it to sound like it's not a strategy we like. It's just not, we think our general bias is toward total return approach to investing. And the dividend emphasis is less so that way. But it does offer a nice complement to our other strategies oftentimes. So thanks, Brian.
Yeah, and definitely, I didn't want to give the impression that we don't like it. It also has its purpose with certain estate plans, as we've learned recently, where
Right.
they benefit from income and not necessarily the growth of the plan. So why not TIPS? TIPS stand for Treasury Inflation Protected Securities. So during a high inflationary environment, they must do great, right? The answer is no, oddly enough. So the TIPS are really good at protecting against unexpected inflation. But once the inflation gets priced in, they do really poorly. In fact, it's a double whammy because the inflation gets added on to the principal, which you're not going to receive for many years, which extends your duration during a rising interest rate environment. So we can see here the purple line there is the TIPS line, and that's down 9% from the beginning of the year from when I pulled this chart. Now, we've preferred to do things like in short-term bonds and floating rate bonds because we're going to get paid more quicker as the bonds mature in the fund, reinvested in the higher rate. And you can see that those bond funds, the ones that we've prioritized, have done much, much better than Treasury inflation protected securities, which might be counter to conventional wisdom. Particularly speaking, the shorter one that we have, it's got duration under 1 year, is fairly stable throughout this tumultuous year. So what's going on with the small cap portfolio? For those of you that don't know, we do have a very, very aggressive individual stock portfolio. It consists almost completely of small caps, and this chart is really designed to show why we're optimistic about a lot of the names in the portfolio. These are the gross profits of these companies and their trends over the last 3 years. You could see that 156% at the high end and 30% growth on the low end over 3 years. These companies have only gotten better, and their stock prices have not at all reacted. And this can be the case certainly in a distressed market, but it can be exacerbated in the small cap portfolios because of lack of liquidity. So, if there's not a lot of share count, somebody puts in a big trade, for example, it's going to really pop the stock. If it's not a big share count, not a big float, if somebody sells a stock, it's going to get hammered. So they could be very volatile, but over the long term, if you believe, as I do, that stocks reflect the fundamentals of the company, these companies have only gotten better, and we have reason to be optimistic about them. So let's talk about market risk and mitigation. For those of you who read the Investor Insights letter that's going to go out this quarter, I get into this in more detail. But the Fed can do kind of 3 things in response to inflation right now. They can slam on the brakes, which I think they're currently doing in the last month or so. They're slamming on the brakes, which is going to dull long-term inflation expectations, bring down longer-term interest rates, which we've seen them anchored at 3 since they started to do this, which is going to be good for intermediate duration investment-grade bonds, which is why we've maintained some, even though we've brought down the overall duration. But it also means that there's a recession risk. So we want to be careful on the risk asset side. So we showed how we were taking less risk, how we're going to be underweight stock a little bit, but we're going to favor some high yield. That's all designed to try to perform even through the recession. They could do a gradual touch, which I think they will do after they're done with this break slam approach. I think the market's right now pricing in a 50 basis point move in September, which to me is a return back to the gradual approach that they had in the first 6 months of the year. That should benefit short-term fixed income, which is why we have a healthy amount of short-term fixed income. And it should also benefit low volatility and value funds. And then finally, the Fed's going to reach a maximum point where they're comfortable with the rate that they've reached. And I think that's going to be around 3% on the Fed funds rate, which they should reach by the end of the year. At least that's what the market's expecting. And once they hit that point, we're going to start to see growth stocks perform better as inflation comes down. And you might start to see a recovery from the recession. So ultimately, we want to be positioned for all of these things, which means that we're going to be very, very diversified. You're going to see growth stocks in your portfolio. You're going to see value stocks in your portfolio. You're going to have intermediate investment grade funds, but you're also going to have a healthy amount of short-term funds. And finally, you're going to have alternatives like commodities. So we're going to have a global slowdown caused by higher inflation. We talked about that. What are we doing? We're underweighting stock in favor for credit-oriented fixed income. I'm going to say that quite a few times during the next couple slides, and I know you've probably heard me say it a lot, but it is the big change that we're making this quarter, where we're going to take away some actually mortgage assets, and we're going to take away some stock assets, and we're going to favor unsecured high yield corporate debt. The U.S. slowdown in deficit spending, we're going to continue to have intermediate term treasuries and investment grade bonds. And I know that's frustrating because year to date, the intermediate bonds are down 8-9%, and that's not necessarily what we expect about from bond funds. But let's keep in mind what a bond is. It's going to mature. It's going to pay out. It's going to reinvest at higher rates. It's going to give you better future cash flows in the future. So even though we see this unrealized loss, which you would see in a CD or any other kind of asset that you might buy, that's not a bond fund, even though we have this unrealized loss, it doesn't mean that in time we're gonna realize that. Now, if inflation does get under control, and we've seen that it's starting to trend down, then you could have a lot of benefit from your intermediate treasuries. Higher inflation is cutting discretionary budgets. So what did we do in response to this? Well, in Q1, we decreased the beta. I showed you that chart. We went from the beta of 104 down to 98. We decreased the preferred stocks. So for about a year, we had preferred stocks in the portfolio. This was an attempt to have something that was equity-like, but paid significant interest rate. And it's mostly bank positions, and they were very healthy. We got out of that as recession loomed and interest rates started to increase. And then finally, now we're just straight out underweighting stock. So, there's times like these, sometimes it can be difficult to realize that there could be opportunities. I would like to point out, I don't like to talk about the short term often, but one thing that is important to note is that the market has been up fairly significantly in the last month. So people are asking me, has the stock market bottomed? That's a common one. And I always say I don't time the market. But a lot of the individual stocks that we have look like they have bottomed. They're 20-30% off their lowest price. You can see that the overall market, the NASDAQ's up almost 7%. The S&P 500 is up almost 5% in the last month. It seems like at least we're getting buoyed a little bit in the short term. Now, what could make it really, really, grease the wheels? I think a ceasefire would. And we've talked about this on the radio. I'm not rooting for this. But if the Russians do take over the Donbass region, I do think it's more likely than not that we'll probably see a ceasefire at that point, or at least the Russians willing to negotiate. A global slowdown, paradoxically, an increased employment and decreased interest rates and inflation would buoy growth stocks. That's one of these things where bad news can be good news, because the bad news means that the Fed's going to stop being so aggressive, which could be good news for stocks. And finally, again, credit spreads make high yield very attractive right now. So the takeaways, I think this has been the theme all year. If you're feeling uneasy about short-term risk, let's discuss your risk profile. There's no reason to take more risk than you need to. Over the long term, all asset allocations outperform the average investor. So let's make sure you're taking the right risk for you and that you stay in it. Inflation's high, but we're in the midst of a slowdown, which could drag down inflation. Inflation suggests that we should be in short-term bonds, commodities, and a slowdown suggests longer-term bonds, lower beta, and underweight stocks. And we're doing all of those things. So again, very, very diversified. I don't think all our assets are going to hit home runs every day over the next 6 months. But I do think this mix of assets will give us great risk-adjusted returns. So again, finally, the bond spreads make credit more attractive. Any additional questions?
Okay, I just like to remind everyone, if you want to ask a question like David has, you can use the Q&A button And we'll dive into those questions now. Before we do, I want to mention that if you're interested in each quarter, we do not only a portfolio market oriented webinar, we also do a financial planning webinar on a different topic each time. The next one is planned for August 24th. And then next quarter, we will also do our quarterly economic and market update, as well as a financial planning webinar. Those are scheduled for October 12th and November 16th. So you may want to mark your calendars. Before the webinar today, we did have a question sent by email. So we'll start with that. And Michael gave a really substantive question here. Given that the market year to date has reported quarterly losses among both stocks and bonds, the first time since the mid-1990s, how have portfolios been reallocated? Is it worth putting any new money to work at this time? And if so, where? And I presume that holding on to excess cash is not recommended given a 9% inflation, but many stock allocation strategies are down by similar or greater amounts. So great question from Michael. And, I do think I'll let Brian ultimately talk about the allocation response in just a moment. But I think the bottom line here, Michael, is that it is worth putting money to work because by and large, both stocks and bonds are down, and it gives you opportunity in relative terms. We just talked about how we're adjusting some of those principles when it comes to the bond market and high yields. Similarly, buying stocks down from their highs, we don't know, as Brian just said, whether we're at the bottom necessarily, but we're certainly a lot closer than we were at the beginning of the year. And it does seem like it's a reasonable time to be deploying new resources as a consequence of that. Brian, I'm sure you have a few thoughts to share on this as well. I'll let you chime in, and then we'll go on as well.
Sure. So I think we addressed in the presentation the reallocation, but I'll just review it real quick. We took significantly less interest rate risk. So all our bond funds outperformed the aggregate bond index, which, tough consolation prize. I understand when the index is down 11%, and our funds are still down year to date, but significantly less. But let's keep our thoughts about how fixed income really works. We are going to get par eventually, and we're going to be able to reinvest at those higher rates, and that's why we're taking less duration, so that can happen faster. We've taken less beta, so we were very aggressive in 2021. We're relatively defensive here in 2022. Even things like in our alternative space, we were in real estate, primarily CMBS and operating REITs, to a nice degree in 2021 when we wanted to take more risk. And now, that's more balanced into, carbon credit futures and commodities for all alternative risk positioning, rather than the real estate sector, which has gotten slammed. Finally, Michael, I know he's in individual stocks, so one of the big positions that we changed in the individual stock portfolio is we bought a company. The ticker is LNG. It's called Cheniere. It's the biggest liquefied natural gas refiner in the United States. They have been spending many, many billions in capital expenditures over the years to get these refineries online. And it seems like it's kind of the perfect storm right now. As these refineries are coming online and they don't have to spend as much CapEx, we're also seeing 20-year contracts for liquefied natural gas at prices that we haven't seen ever in the natural gas business. So we are looking for opportunities. We are reallocating the portfolio. We're shortening duration again. We're taking advantage of high yield. And finally, on new money, for you personally, again, I think we're seeing some unbelievable values in some of these individual stocks, more value possibilities in individual stocks than in the ETF space, which I think is around fair value. because there's still some significantly overweighted stock, overvalued stocks, and now there's some very, very attractively priced stocks on the other side. Now, like Chris said, I'm terrible at timing the market. I'll be the first person to tell you that I can't do it. I think what my expertise is in is finding good businesses at good values. Now, that the frustrating thing on that is, it can take time for either those returns to compound into dividends and share repurchases, or B, it could take time for the market to catch on to what I'm seeing. And that's why we can't time the market, but we think there could be a great opportunity to put additional money to work.
Okay, next question is from David. What are the alternatives to the GDP as economic tools to address stagflation or inflation in the US and world economy and effects on stocks, bonds, ETFs, et cetera?
I'm not sure I understand the question, but the alternatives to GDP.
Well, let's just talk about what are some of the measures that you might be paying attention to when it comes to looking at economic progress. And David, feel free to add additional color if you'd like.
Well, the reason why we've had a rapid sell-off in all assets is because of the inflation. So inflation leads to higher interest rates. Unexpected inflation leads to even higher longer-term interest rates, which affects stocks. If you have a rising treasury rate, you're going to have a decrease in stocks. I'm not going to get into the whole time value of money thing, but just believe me, that relationship works. Now, it's more direct with bonds. Interest rates have like a one-for-one relationship with rises of interest rates. So we're really concentrated on inflation right now. And the federal government is actively fighting it. So what do I mean by that? We're not spending nearly as much money as we were in 2020 and 2021. So it's inflationary. It's deflationary, not the deficit spend. We're raising interest rates. They're doing balance sheet runoff. I mean, the Federal Reserve might have been too lenient in 2021, but they're definitely not being lenient now. I mean, this is very, very aggressive monetary policy. I think the biggest thing to see if the inflation is going to start to fall is if the unemployment rate starts to rise. And you've seen that unemployment claims have started to rise, but the rate hasn't actually fallen. I think with time that's going to happen. Normally, we actually enter recessions with employment being pretty robust, and then at some point early in the recession is when it starts to fall. So that's part of the reason why I also don't think they're going to call it a recession. But the reality is, I think we're going to see an increase in layoffs, an increase in unemployment claims, and ultimately an increase in the unemployment rate, which will bring down inflation. It just won't be pretty, won't be the easiest way to do it.
All right, thanks. And again, if you have a question, you can use the Q&A button to type in your question, and we'll try to give you a response. If you think there's a need for additional color there, David, feel free to type right in. Kathy has a question. She invested her money about 9 months ago and has lost about $100,000 since then. How long will it take to get that money back and then actually make some money? Of course, we have no way of knowing what the actual timeline will be for sure. But I did say at the outset of the program that I think if we're looking in 3-year increments, we have a much different perspective. Although markets are down substantially year to date, if I look at it over a 3-year period, I'm most likely positive and, maybe nicely positive. I think we can expect something similar as we look ahead. A year and a half from now, 3 years from now, I think you're going to have a very different kind of perspective about how your performance has taken shape. But honestly, there's no crystal ball as it relates to this, and it will take time for us to know for sure. Brian, do you want to add anything to that?
Well, the only thing we can't time it. There's no way to possibly know. when that money will be recovered. But what I will say is some overwhelming evidence that when consumer confidence is at its lowest, it's when forward returns are at its best, which is counterintuitive, right? As a lot of things in finance often are. But I think it's true. And people are very downbeat about a lot of things right now, and there's some good prices to be had, and all that will work itself out in time. The key is time. It's frustrating. I just want to reiterate what Chris said, that if we look at any of our strategies over a 3-year period, they're all robustly positive relative to the market environment. So,
to reiterate that point, Brian, there was an interesting comment that David Kelly provided at a presentation recently where he was talking about market sentiment and consumer sentiment and markets. And it was interesting when it said that, I think it was over the last, do you remember, something like the last 25 years, 50 years, I've forgotten which, but it pointed to about 5 periods where they had peaks and maybe 5 periods where there were troughs. And inevitably, if people invested when consumer sentiment was at its high, they had much lower, maybe like a 4% average return. But if they invested when investor sentiment was terrible, but within 12 months, they were up maybe 25% or something like that on average. That's not a prediction or of any kind. It's really simply a point that investor sentiment, consumer sentiment is at near all-time lows. You have to expect that a year from now, things are going to look a lot more attractive when it comes to investment. It may not be 12 months, literally, it may be, 2 years, I don't know what. But I think the reality is that this is not a bad time to be focused on staying invested or putting money to work because of the opportunities that exist. Anything to add to that?
I just looked up some data quick for Kathy. In 2000, during the financial crisis, the market peaked in the fall of 2007. And, it really took until 2013 to get back to where the peak was in 2007. So it can take a long time. I mean, I don't want to promise that this is going to get better quick. That was a much different, I'd say much worse situation than what we're currently seeing right now. But that, just to give you an idea.
The expectations of recession are far, whether or not it's accurate, but the broad expectation is of a much more shallow and shorter recession concern. Brian, we do have a couple more questions coming in. Perhaps you can move the slide to the next page so we can share our disclaimer or disclosure contents. David followed up, it looks like. GDP estimates the throughput of goods and services in the US economy, but doesn't measure increased efficiency producing these goods and services in utilizing natural capital and ecosystem services. Plus, it ignores surprises like COVID-19, climate change, Russian-Ukraine war. So I guess he's saying, is GDP the best measure for us to be looking at to incorporate some of these other considerations?
Yeah, I mean, I'm still a little unclear on it, but I think GDP is one thing that we look at. I actually think I spend far more time looking at valuations and the business environment than I do at GDP. But I do think it could be a leading to what we
and PCE when it came to the inflation. There's an abundance of economic measures that are made use of in trying to evaluate directionally how things are moving.
Just to elaborate on GDP, this might be really boring to some people, but there's 2 ways to look at it. There's the demand side and there's the production side. The demand side, it's government spending plus consumption plus business investment minus exports minus imports. But then there's the which is, I think, the often quoted one. But then there's the supply side one, which I think David is getting to, which is the change of labor plus the change in available capital multiplied by a factor called total factor productivity, which is just a measure of productivity in the economy. And the difference between the demand side and the supply side is where you get inflation. That's the plug, if you will. So right now we have way too much on the demand side and not enough on the production side. So the inflation is taking into account those changes in productivity, which is I think what you're getting at. But that's fairly mathematical and probably more than anybody cares to know.
As we move to the conclusion today, I think it's worth just trying to put some perspective around where we've been and what's been happening and where we're headed, which we've tried to do throughout the program today. But, you know, we have to remember we've been through a real shock to the economy. The COVID-19 created significant disruption, basically stopped the economy in its tracks in the effort of saving lives. Monetary policy turned sharply towards stimulative efforts. Fiscal policy was dramatic in the amount of money that went out in the form of unemployment benefits and PPP and checks to households. In the consequence of that, markets soared and inflation soared. This year, markets have declined in the face of a reversal of monetary policy with rising interest rates by the Fed, a far less stimulative fiscal policy with less excessive spending. Supply chain issues persist but improve. We've had the Russian invasion of Ukraine, which exacerbated some of the food and energy costs. And we see that inflation appears to be, at least on the core level, starting to taper, though it's early in that process. And all along the way, we've been responding with your portfolios when they're discretionarily managed in efforts to try to position you in a way that is responsible within your risk profile. So if you have any questions, if you have concerns, if there are things you'd like to talk about, please do reach out to us. You can connect with us through the website, amrfinancial.com. This program will be posted, so please feel free to share it with others. You can also reach out to us directly by phone, either toll free at 866-771-8901 or our local number 508-771-8900. With that, Brian, I think we've reached the end. If you have any concluding remarks, I turn it to you to wrap us up.
A great summary, Chris. Thank you, everybody, for your time. We'll keep on moving on.
Hang in there. Why don't you change that slide? I think you got one more disclosure.